Hi everybody, and welcome back to video number 9 in chapter 15. And when we left off, we were looking at using this treasury stock method to determine the per share effect of options, which we concluded was 0. Now we move on to the per share effect of the 8% bonds using the if converted method. And so again, we take 8% of 2.5 million. That's our interest expense. Our income tax reduction of that, which is going to be 20% of 200,000. Or we could have simply multiplied 200,000 times 0.8 to get 160,000 of expense avoided net of tax. And our number of common shares issued, assuming conversion of the bonds, and we had 202,500 bonds and 40 shares each, so that would be 100,000 shares. And so we're going to take 160,000 and divide it by 100,000 shares, giving me $1.60 in per share effect. Okay, so if I move on to the 10% bonds using the same method, here we take the 10% of 2.5 million, give us 250,000. Again, I can multiply that times 0.8 to get 200,000, which is the interest expense avoided net of tax. And the number of common shares, again, 202,500 bonds times 40 shares gives me 100,000 shares. Dividing 200,000 by 100,000, I get $2 per share. Okay, now if we look at the 7% convertible preferred using the if converted method, I'll start out with 25,000 shares at $7, gives me 175,000. Dividends are not a tax deduction, I think, as everyone knows, so our dividend requirement avoided is going to be 175,000. So the number of common shares issued, assuming conversion, is going to be 2 times 25,000 shares, and that'll be 50,000. So I can take the 175,000 and divide it by the 50,000 shares to get $3.50 per share effect. So if I add those all up, here's our options at 0, $1.60 for 8% convertible bonds, $2 at 10% convertible bonds, and finally $3.50 for the 7% convertible bonds. And we're listing them from smallest to largest in the ranking here. So the next step then is to determine the earnings per share given effect to the ranking. So we have income applicable to common stockholders, which is $1,575,000. The incremental numerator effect of options, which is none, gives us that same total, divided by the weighted average number of shares outstanding. So we're going to add the incremental denominator effect of the options from the previous calculation. And that's 16,667. And we are going to then recompute earnings per share, taking that 1,575,000 divided by 516,667, and that gives me $3.05 recomputed earnings per share. All right, now if we do the 8% convertible bonds, this prior one was the options. Now if we do the 8% convertible, we're going to do the same thing here. We'll take interest expense avoided, so we will come down to 1,735,000. The denominator is going to be 516,667, and we'll add the 100,000 common shares assumed, assuming conversion of the bonds, and that takes our total to 616,667. So the recomputed earnings per share is going to be $2.81 for these 8% convertible bonds. Now moving on to the 10% convertible bonds, we start with our numerator of 1,735,000. We add back the interest expense avoided, net of tax, and that gives us $1,935,000. The denominator from the previous calculation is 616,667. We add another 100,000 assumed issued from the conversion of those bonds, takes us to 716,667, or $2.70 recomputed earnings per share. Now our 7% convertible preferred will start out with the 1,935,000. We got that from here. And we'll add the dividend requirement avoided. Okay. No tax implications there. And the denominator from the previous calculation, we'll add another 50,000 on top of that little beauty. And that gives us 766,667 total. So we divide the $2,110,000 by the 766,667 shares. It gives us $2.75. And seeing how the recomputed earnings per share are not reduced, the per share effects of the convertible preferred are not used in the computation. So our net income then is going to be $1,750,000, the basic earnings per share that we did earlier, and now the fully diluted earnings per share of $2.70 that we calculated here, not the $2.75 that we calculated with the 7% convertible preferred. Okay. So assume that Barton Company provides the following information. We have income from continuing operations, loss from discontinuing operations. Our net loss was $1,200,000, and our weighted average number of shares outstanding is 1 million shares, and so potential common stock 200,000. So our basic earnings per share, pretty easy to figure here. 2.4 million divided by 1 million gives me $2.40. The loss from discontinued operations, 3.6 million divided by 1 million shares. So we have $1.20 of net loss. The fully diluted earnings per share, pretty easy to calculate here. We take that 200,000 here, and we add it to the million to get 1.2 million shares, and we divide that through the same numbers we did for the basic earnings per share to get $2 from continuing operations, a $3 loss from discontinuing operations, and a net loss of $1 per share. Okay, now we'll compare the accounting for dilutive securities and earnings per share under GAAP and IFRS. Similarities. IFRS and GAAP follow the same model for recognizing stock-based compensation. The fair value of shares and options awarded to employees is recognized over the period to which the employee's services relate. Although the calculation of basic and diluted earnings per share is similar between IFRS and GAAP, the boards are working to resolve the few minor differences in earnings per share reporting. One proposal in the FASB project concerns contracts that can be settled in cash or shares. IFRS requires that share settlement must be used, while GAAP gives companies a choice. The FASB project proposes adopting the IFRS approach, thus converging the IFRS and GAAP in this regard. Relevant differences. A significant difference between IFRS and GAAP is the accounting for securities with characteristics of debt and equity, such as convertible debt. Under GAAP, all of the proceeds of convertible debt are recorded as long-term debt. Under IFRS, convertible bonds are bifurcated, meaning they are separated into equity component, the value of the conversion option of the bond issue, and the debt component. Okay, then in the second bullet point, related to employee share purchase plans, under IFRS, all employee share purchase plans are deemed compensatory. That is, compensation expenses recorded for the amount of the discount. Under GAAP, these plans are often considered non-compensatory, and there is no compensation recorded. Certain conditions must exist before a plan can be considered non-compensatory, the most important being that the discount generally cannot exceed 5%. More differences include modification of a share option results in the recognition of any incremental fair value under both IFRS and GAAP. However, if the modification leads to a reduction, IFRS does not permit the reduction, but GAAP does. Other earnings per share differences relate to 1, the treasury stock method and how the proceeds from extinguishment of a liability should be accounted for, and 2, how to compute the weighted average of contingently issuable shares. All right, that ends Chapter 15. And when we continue, we will start with Chapter 16. Until that time, bye for now.